Okay, you ready for this? The withdrawal, the acceptable starting withdrawal rate for your portfolio edged up this year. The calculations are getting better. That's good news, right? I think. So I call this one the news of the weird. All right. Morningstar released its research on November 13th. They do this research every single year, doing statistical analysis of portfolios and the best way to handle the 4% withdrawal rate portfolio that because of the combination of 9/11 and 2008 was debunked. That back in that decade of 2000 to 2010, the math no longer worked. The statistical analysis said you can't pull 4% in perpetuity. Well, we're back to the 4%. It's now back to the 4% from 3.8 in 2022. Now, this model performed best with portfolios with modest equity weightings between 20 and 40%. That means in the rest of our terms here, this is a 40-60 portfolio, 40% stocks, 60% bonds, because that's all Morningstar talks about is bonds. Then the increase is primarily because, well, the obvious, interest rates are higher, you have better yield out there in your safe portfolio, and we aren't seeing the inflation we were seeing for the last couple of years. Kind of a duh moment, of course. So this only targeted a success rate of 90%. Starting withdrawal rate of 4% only succeeded 90% of the time in their analysis. If you want a better success rate than that, you need more bonds. So I want to talk about this. The 4% withdrawal rate rule that everybody seems to have in their head, I don't think anybody actually knows what they mean by the 4% withdrawal rate. So even back when the MIT professor created that 4%, I think it was MIT, created the 4% concept of withdrawal, it started with somewhere around 60 to 80% of the portfolio in bonds. Only back then, bonds were paying over 10%. I still struggle with this. Wait, bonds? You could get a 30-year bond paying 10%. And you telling me I can only pull 4% from my stock portfolio? Well, what planet does this make sense? I thought these people were good mathematicians. I struggle with this. I always struggled with this concept of a 4% withdrawal rate, but neither here nor there. This is how it works. Deposit 60% of your money, or more conservatively, 80% of your money if you want a better success rate. In stocks, and the rest, let me start over. That's 60% to 80% in bonds is what they want you to do. We know where they make their money, obviously. And then they want you to put the rest, 20 to 40% in stocks. So here's the example, S&P 500. I actually, in my spreadsheet, used the last 30 years. I used 30 years. I go all the way. I had to speed it up here. I couldn't fit all of that on this. So I used 30 years of the S&P 500, and then the Barclay Bond Index has a 30-year history, so I use that one as well. So 40% in the S&P 500, 60% in the Barclay Bond Index. Calculate 4% of your portfolio upon retirement. So $1 million in savings, 4%. Okay. Pretty simple. You got 5 million, you got 10 million, just 4% of that, whatever it is, that you can calculate 4%. And they're saying that then that $40,000, you can increase it to inflation every year. So all I did, I think, was a 3% inflation increase here, which is statistically what most companies use as the average here. So that is what the 4% withdrawal rate is. You retire, you calculate 40% of your savings, and then you increase it to inflation every year. And that's 60-40, 60% safe, 40% bonds is supposed to last you 30 years. That's all they really try to analyze statistically. And the success rate is a 90% success rate. They're predicting that 90% of scenarios, whatever happens in the markets between now and 30 years from now, which is 100% unpredictable, they feel, they being the minds that tell us what to do with our money, think that 60% in bonds, 40% in stocks with 90% certainty will handle this withdrawal rate all the way into the future. And just so you know, at year 100, we're withdrawing 79,000 and we only started at 40. So they increased it to inflation. So what does all this mean? Well, it should mean nothing to you. It should mean that this is all silliness. Absolute absurd silliness. You want to just kind of get a roundabout idea of what you can pull from your portfolio. You want to use 4%, go for it. I don't have a problem with that. But the takeaways that we should be taking from this is understanding why and how this happens. And I hate this chart because the chart that's out there is actually your age on the bottom of this chart. And that has nothing to do with your actual need for money. Okay, so when we look at this chart, this is your allocation to equities. This is your allocation to stocks. Okay, this is what they teach in the CFP. This comes from all the big statisticians in the industry that sit around and all they do is study investing and what's the best way to defend people in court and come up with proof that this is the right way to invest money. Well, it's overgeneralizing because it has nothing to do with your age. Okay, so if you need your money, there's that 60-40 portfolio, 40% in stocks, the rest in safe investments. That's what you need to understand. This is only if you need your money. So some of the rules you should live by. As you approach retirement, if you're going to rely on your portfolio for a comfortable retirement, even if it's a portion of your comfortable retirement, you need to understand that that's where you should begin that transition to safe portfolio. That should be the core of your portfolio as you're heading towards retirement. And I always say kind of that 5-year window. Hey, if you're going to rely on your savings to fund any part of your retirement, is, to make it enjoyable, then you really need to start pulling back before you retire. The higher your dependence on your portfolio for income, the less you should be leaving it to chance. The statisticians understand the math works against you. The more volatile your portfolio is, the bigger trouble you're going to be in if you're pulling from there regularly. So the larger that withdrawal rate, the greater the effect of volatility. 0.01% withdrawal rate is not affected by volatility. 3%, 4%, 5%, even 6%, yes, volatility is your worst enemy. Absolutely, unequivocally, your worst enemy. Okay? So just remember, from 10,000 feet, we need to live our life by this rule. Deposit into volatility to build your wealth, but withdraw from stability to maintain it. That's the rules we need to live by. Efficiency is the key to your success. You need to make sure that you're paying less taxes, that you're paying attention to it. You're not paying more taxes than you need to because that eats away at your money, right? You need to make sure you're not paying a whole bunch of fees you shouldn't be paying. Things like, what we call 12B1 fees or mutual fund commissions that are coming out of your money and you don't even know what's happening. You got to be careful about some of the sneaky fees that are out there that nobody tells you about. Okay. We also want to make sure that your investments are in the right parts of your portfolio. Each tax class is going to take different set of rules, which is going to have a different set of investments in there. So efficiency. If you create the efficiencies in your portfolio, you have less drag, less things eating away at your portfolio, which means we can reduce the risk profile, making it more reliable, more predictable for you, and not give up any of that performance. So it's important to understand that efficiency is how you're really going to do much better when you head off into retirement and start withdrawing money from your portfolio. So these are the things that you got to think about. So keep an eye out. I've got another video. I'm going to really play around with my spreadsheet and show you the order of returns. This is a concept that applies to all of this, that it helps explain why you need 40% in the stock market, 60% in safe investments. The order of returns will help you explain or help you see the math, help you see what happens with turbulence in your portfolio when you go to start withdrawing. It's not pretty, okay? So keep an eye out for that video. It's coming out soon. And I've got some other videos in here as well on that concept. So if I can help in any way, I'm always happy to help. Give us a call, shoot us an email. This is what I love playing around with and doing, the whole math behind all of this. Stay in the big picture, understand your situation, create portfolios for yourself. That's what's important. You can't just hang your hat on something that they overgeneralize for the whole world of investing. It has nothing to do with you. You might not need 4%, right? So everybody should be looking at their own situation and trying to figure out the best path for you, right? That's what's important. So always let me know if I can help. Happy to get together with you and discuss your situation at any time. If you haven't subscribed to the channel, please, we want to get over that 1,000 mark, and share the video with your friends if you need to or want to. Appreciate it. All right. See you next week. Thanks a lot.